Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra, and on this special edition, our focus is on the Q4 earnings. HCLTech has reported largely in line with expectation numbers yesterday, and no negative surprises, which was a big breather. Profit rose 11% on a year-on-year basis, but on a sequential basis, it did fall about 2.8%. The company, however, has pegged the FY24 guidance between 6 to 8%, which although is half of the growth that was clocked in the current fiscal year, that's FY23. Now, to discuss more on these numbers and the outlook going forward, I'm joined by the top management of the company. Mr. Prateek Aggarwal joins in. He's the Chief Financial Officer. Welcome, sir, and thank you so much for taking the time out for this discussion. Well, decent numbers to begin with, and that's good in a slowing quarter, or the quarter which is seasonally weak as well. But let's begin with the guidance front only. 6 to 8% for FY24. While this is in line or slightly better than your larger peers, on a Y-on-Y basis, there is a reduction for sure. Can you break it down for our viewers? How much of are the concerns on the macroeconomic uncertainties? What kind of concerns are there on the economic slowdown front? And what kind of concerns are there on the banking crisis that we saw recently, leading to uncertainties that would keep the growth capped at 8%?
Sure, Sakshi, good morning, and thank you for those list of questions. I'll hopefully remember everything. If I forget, then ask me again.
Yeah, sure.
So first of all, I think FY23 was a great year for us. We crossed a very significant milestone of 1 lakh crores in our revenue in rupee terms. That's 1 trillion rupees, in other words. So all 225,000 plus employees of HCLTech, we are all very delighted to cross that significant milestone. And as you rightly said, our growth for the year has been, pretty impressive at 15.8% in our services business, which is amongst the large cap top tier players the highest. So we are pretty pleased to be able to deliver that as well. And overall, of course, it is 13.7%, which includes the performance by our software division, which has also grown by 2% roughly on a year-on-year basis, excluding the divested business from the base. So all in all, a great year, and we've come within our guidance range, both on the top line, 13.7% growth, as well as on the bottom line, we had promised 18 to 18.5. So we've come towards the middle of that guided range at 18.2%. Now, coming to the guidance question for the next year, we are happy to guide 6.5 to 8.5 for our services business, and factoring in slightly lower growth from our software part of the business. The total company guidance, as you rightly pointed out, is 6 to 8%. And on a EBIT margin, given we exited the last quarter was at 18.1 and the full year was at 18.2%, we've kept our guided margin range at 18 to 19%. Our medium-term aspiration continues to be 19 to 20%. You will note that FY19 and FY20, the two pre-COVID years, both of them were at 19.6%. So that is our medium-term aspirational range, which we hope to get back sooner or rather than later. And but for the current fiscal year, which is already started, FY24, we are guiding a little 1% lower than that band because of the volatility that we are going through and the uncertainty that sort of persists maybe for a quarter or two. So that's how we are factoring in the next year. You also asked about financial services. Financial services has been our best growth driver in this quarter, and we would continue to expect financial services to do well for us on the back of the deals that we signed in the last 2 quarters. So at the end of September, viewers would remember that we had called out a large mega deal, $125 million ACV, which was starting to kick in from the latter part of this quarter, which is what has driven that number. And going forward, next quarter and onwards, we will have the full quarter impact. So all that is helping our financial services growth going into the future. I'm sure I missed out one or two aspects. You can please.
I will ask you, sir. Mr. Aggarwal, I wanted to actually ask you on this factor only, the banking crisis. After this, has there been any slowdown concerns leading to any delay in projects? Are there any stall projects as well? And how do you really see the demand panning out for you in FY24? Because I wanted to understand, is there any visible sign in terms of client spend and the deal pipeline?
Sure. So on the financial services side, we are not seeing that. Like I said, we are actually ramping up on time on the deals that we signed in the previous 2 quarters. And also, the other thing which has been in the news and in the
Yes,
viewers' minds is all these, US regional banks and one of the European banks as well, etc.
sure.
So I would like to reassure our viewers that our so first of all, financial services as a component of the overall services business is 20-21%. So this quarter it was 21%. Last quarter was 20%. So that itself is amongst the lowest compared to most of our peers. And within that, we have done a thorough analysis of customers who may not be at the best, credit rating or where we would like to see the credit rating, and therefore could be a little bit on the lower side. So that number is frankly less than 1% of our BFSI revenue.
Okay,
So
okay,
you can imagine of the 20%, 1% is like
sure.
0.2% of the total. So it's not something that worries us or should concern any of our shareholders.
Got that. Mr. Aggarwal, the other important point that has been on top of, the minds of a lot of, your employees as well, there were concerns around variable payouts being slashed by the IT companies. I wanted to understand from your perspective, have you made any changes to these payouts at all? And also going forward, what are your hiring plans for FY24? Are you on course to hire as per initial plans, or are there any chances of seeing any slowdown there too?
So let me reassure again on those fronts. In the press conference yesterday,
Yes.
Ram already called that out. We are not changing any policy on our variable pay. Variable pay for large section of our workforce, let's say about 85%, I think is just about 5% of their total pay. So first of all, it's not a significant number, and we are not changing any of our policies. We continue with what we have been continuing for a long time now. The second thing is uh, on
On the hiring.
sorry.
Hiring.
Yeah, on the hiring plans, we are factoring in a lower requirement for gross hiring numbers, primarily driven from two or three factors. Number one factor is, our quarterly attrition in the last quarter, March quarter, was roughly just about half of what it was in the June quarter last year. So Q4 attrition versus Q1 attrition has come down significantly. So the backfill requirement of those attriting has therefore come down by half, right?
Okay.
The second thing is obviously, uh, our growth was 15.8% last uh, year in our services business,
Yes.
and now we are guiding to 6.5 to 8.5. So that is again kind of, if you take the midpoint 7.5, for instance, it is less than half of 15.8%. So both those reasons would require us to hire lesser number of people going forward. Also, there is always some impact of more and more automation, and now there are new tools coming into the frame, like the AI tools that have been in the news recently. All those will make the gross hiring number come down. We have toned down our fresher hiring requirement for the next year to about 15 odd thousand numbers compared to the 27 odd thousand that we hired this year,
Yeah.
which is again in keeping with those half kind of gross hiring numbers. So that's how I would break it down so you understand it well.
Sure. Mr. Aggarwal, just last one question, and that's again on the hot topic, and that is on AI and generative AI, chat GPT. I wanted to understand two parts to this. Question one, are you looking to increase your focus in these areas? Are your clients looking for more integration from you on that? And on the second part that I wanted to understand, do you see that going forward, your AI focus can therefore reduce your hiring needs in some of the verticals or segments?
So, Sakshi, we've obviously been talking about this. The way we look at it is, it's the quick trigger that all of us sort of leap to is, the machine will replace the human. But practically and frankly, that's what we've seen over a long period of time for decades and maybe even centuries for technological advances of any type. Typically, what actually happens, transpires on the ground, is that the human and the machines work cohesively in tandem and improve the output and the productivity that we can deliver. So, we are very focused on approaching this topic as a human and machine and AI sort of working together, helping each other to deliver the best outcome to our clients and our stakeholders. So that's the way we are approaching it. It's frankly not completely new. It's become more talked about in the media in the last few months, but we have been incorporating AI in some of our software tools for some time. And, we'll just up the ante and continue to increase the human and AI team, as we call it, as we deliver better outcomes to our clients.
All right, with that, many thanks, Mr. Aggarwal, for being with us and sharing all the insights. And here's wishing you all the very best for the coming quarters, and hope to speak more with you about the insights on the IT sector and going forward, what is the visible outlook on the growth as well. Many thanks for being with us.
Thank you, Sakshi, very much, and have a great day.
If you like the video, do like, comment, share and subscribe.